Since ChatGPT launched in November 2022, the stock market has surged over 70%. In that exact same time period, job openings have crashed by 30%. Economists are calling this the scariest chart in the world. And what's happening right now is going to affect your paycheck, your job, and your future, whether you realize it or not. Welcome back. If you've been watching the news lately, you've probably noticed something weird. The stock market keeps hitting record highs. The S&P 500 has broken records over 30 times just this year. Major indices are absolutely soaring. But at the same time, regular people are struggling. Unemployment is creeping up. Job openings are down. Young workers aged 20 to 24 are facing a 9.2% unemployment rate, levels we haven't seen since the Great Recession in 2009. So what's going on? How can Wall Street be partying while Main Street is barely getting by? Today we're breaking down the K-shaped economy, the AI boom that's concentrating wealth like never before, and why this divide is only getting wider. Stick around, because by the end of this video, you'll understand exactly what's happening to the American economy right now. Let's start with the numbers because they're kind of wild. The S&P 500 has climbed from around 3840 in November 2022 to approximately 6688 by September 2025. That's a gain of roughly 74% in less than 3 years. Meanwhile, job openings peaked at 11.5 million in March 2022, the highest level since they started tracking this data in 2000. By August 2025, that number had fallen to 7.18 million. Here's what makes this unprecedented. Job openings and stock market performance have typically moved together throughout history. When the stock market goes up, companies hire more people. When it goes down, they cut back. But right now, these two indicators are moving in completely opposite directions, and nothing like this has happened in the entire history of the data. So what's driving this split? The answer isn't what most people think. A lot of folks immediately blame artificial intelligence, assuming AI is destroying jobs while tech companies profit. But economist Derek Thompson points out that the real culprit is actually monetary policy, combined with the AI boom, creating a wealth concentration effect that's unprecedented in modern history. Job openings didn't peak when ChatGPT launched in November 2022. They peaked in March 2022. The exact same month, the Federal Reserve started raising interest rates for the first time in over 3 years. The Fed approved a 0.25 percentage point increase on March 16, 2022, then proceeded to raise rates 11 times through July 2023. Higher. Interest rates make borrowing more expensive, which means companies invest less, spend less, and hire less. That's exactly what happened. By September 2025, the Fed finally started cutting rates to try to revive a sluggish labor market. But the damage was already done. Companies have been in a slow hiring, slow firing mode for months now. They're not laying people off in huge numbers, but they're also not bringing on new workers. Now here's where things get really interesting. While the job market cooled down, AI-related stocks went absolutely ballistic. According to JP Morgan, AI stocks accounted for 75% of S&P 500 returns and 80% of earnings growth since November 2022. Let that sink in. 3/4 of all stock market gains came from just AI companies. JP Morgan estimates that roughly 30 AI-related companies now represent about 44% of the S&P 500's total value. We're talking about a level of market concentration we haven't seen in decades. The top 5 companies, NVIDIA, Microsoft, Apple, Amazon, and Alphabet, now make up nearly 30% of the entire S&P 500 index. NVIDIA alone just became the first company ever to hit a $5 trillion market cap. These AI stocks generated approximately $5 trillion in wealth gains for U.S. households over the past year alone. But here's the problem, that wealth is insanely concentrated. If you own stocks, you probably benefited. If you don't own stocks, which is the majority of Americans, you got absolutely nothing from this boom while watching prices rise around you. The wealthy are getting wealthier because they own these AI stocks. Meanwhile, the average worker is seeing their job prospects shrink as companies automate more tasks and reduce hiring. This is creating what economists call a K-shaped economy, where different groups move in completely opposite directions. Let's talk about this K-shaped economy because it's the key to understanding everything that's happening right now. Imagine the letter K. One arm goes up, one arm goes down. That's literally what's happening in America in 2025. The top 20% of Americans, households making about $75,000 or more per year, are living their best lives. They're spending on luxury travel, lavish weddings, premium products. They're benefiting from the surging stock market. They're refinancing homes at favorable rates. They're doing great. The bottom 80%, not so much. Moody's Analytics reported that the wealthiest 10% of Americans are now responsible for nearly 50% of all retail spending. That's the highest level since they started collecting this data back in 1989. This means half of all consumer spending in America is coming from just 1 out of every 10 people. If you go back to the early 90s, the top 10% accounted for about 35% of spending. Now it's 50%. The economy has become more dependent on rich people's spending than at any point in modern history. And that's a massive problem. Real talk. If this is opening your eyes to what's actually going on with the economy, hit that like button and subscribe. This stuff is changing fast and you'll want to stay updated on what's coming next. For the remaining 280 million Americans in the bottom 80%, prices are rising while wages aren't keeping up. Young workers are getting crushed. People aged 20 to 24 are facing that 9.2% unemployment rate we mentioned. They're dealing with resumed student loan payments, skyrocketing rents, credit card debt piling up. Building wealth or even just maintaining steady financial footing has become incredibly difficult. Economists at Moody's are pointing out that this creates real economic danger. Mark Zandi, their chief economist, says the economy's prospects are now tethered to the fortunes of the well-to-do. If the stock market dips and wealthy people start pulling back on spending, the whole economy could quickly spiral downward. It's like a table balancing on just 3 legs. It works in good times, but it gets shaky fast when things turn unstable. Let's zoom in on what's actually happening in the job market because the headlines don't tell the full story. The unemployment rate has stayed between 4% and 4.3% for 16 consecutive months. Sounds stable, right? But beneath the surface, things are changing fast. Employers added just 22,000 jobs in August 2025, way below expectations. And here's the kicker. Revised figures show the economy actually lost jobs in June for the first time since 2020. When government economists went back and looked at the data, they found they had to revise down job numbers by an average of 7,000 per month for the entire year ending in March 2025. That means the labor market weakness started way earlier than anyone realized. Construction jobs took a massive hit, falling from 33,000 openings in July to just 8,000 in August, the lowest level in nearly a decade. For the last 4 months, virtually all job creation has come from big companies. Smaller businesses all the way down to companies with just 1 to 19 employees have actually been losing jobs for 4 straight months. Small business is really hurting right now. There's only 0.98 job openings for each unemployed American as of August. That means if you're looking for work, you're competing with roughly 1 other person for every available job. That's a completely different landscape from 2022 and 2023 when workers could pick and choose their jobs and there were way more openings than people. We're also seeing what economists call job hugging, people staying in jobs they don't love because they're too afraid to lose the stability. The job hopping era is over. Workers see the labor market in starkly negative terms right now, even though the official unemployment rate looks okay on paper. Here's where things get even more concerning. A lot of experts are starting to ask, is AI in a bubble? JP Morgan CEO Jamie Dimon has warned that a lot of assets appear to be entering bubble territory. More than half of global fund managers now believe AI stocks are in a bubble. Big tech firms are on track to spend nearly $400 billion in 2025 alone on AI infrastructure. Over 5 years, they're planning to invest $5.2 trillion. That's trillion with a T. AI capital spending currently accounts for an estimated half of U.S. GDP growth. Think about that. Half of America's economic growth is coming from companies building out AI infrastructure. But here's the problem. This scale of investment requires generating $2 trillion in annual revenue by 2030 to justify the costs. Current AI revenues? Only about $20 billion. That means AI companies need to grow revenues 100 times over in just 5 years for this to make sense. Historical analysis of similar infrastructure booms, like railroads in the 1860s, electricity in the early 1900s, and the dot-com era, shows that these situations typically result in overinvestment, excess competition, and poor stock returns for the companies building the infrastructure. Without the AI investment boom, some analysts say we'd already be in a recession. The entire economic growth story of 2025 is built on this speculative foundation. If AI doesn't deliver the revenue growth everyone's betting on, or if this spending bubble pops, the stock market could come crashing down, and it would take a lot of household wealth with it. It's not just monetary policy and AI driving this divide. Trade policy and immigration enforcement are playing a role too. President Trump's tariff policies have raised costs for businesses, making them more cautious about hiring. His immigration crackdown is reducing the available workforce. One study estimated that Trump's immigration policies could reduce the U.S. workforce by 15 million people over the next decade and cut annual economic growth by nearly 1/3. Inflation is creeping back up too. The Consumer Price Index increased at an annual rate of 3.0% in September, up from 2.9% in August and 2.3% earlier in the year. Trump's tariffs are putting upward pressure on prices for imported goods. A lot of our coffee comes from Brazil, which is now subject to a 50% tariff, so expect to pay more for your morning cup. The rate of long-term unemployment, people who've been without a job for more than 6 months, soared in August. More and more corporations are announcing layoffs. Microsoft, Meta, Intel, Target, Kohl's. Amazon plans to replace 600,000 warehouse workers with robots. The automation wave is real and it's hitting right now. Meanwhile, data centers powering AI are devouring massive amounts of energy, driving up electricity prices for everyone. Rents are rising as investors buy up properties. Regular people are getting squeezed from every direction while the stock market keeps climbing based on AI hype and the spending of wealthy households. So what does all this mean for regular people? If you're in that bottom 80%, the reality is pretty tough right now. Job prospects are worse than the headlines suggest. If you're young and entering the workforce, you're facing some of the hardest conditions since the Great Recession. If you're looking to change jobs, the market is way tighter than it was just 2 years ago. The economy is increasingly dependent on the spending of wealthy people and the AI boom. That makes everything more fragile. If AI doesn't live up to the hype, or if wealthy people pull back on spending, we could see a rapid economic downturn. And when that happens, it's the people at the bottom who get hit hardest. For now, the stock market keeps climbing, fueled by AI optimism and the investments of people who already have money. But Main Street? Main Street is dealing with higher prices, fewer job opportunities, stagnant wages, and mounting debt. The gap between the haves and have-nots is widening faster than it has in decades. Some economists worry this could lead to serious social and political instability. When the majority of people feel like the economy isn't working for them, while a small group at the top thrives, that creates real problems for society. Just 25% of Americans feel they have a good chance of improving their standard of living right now. That's a record low. The divergence between Wall Street and Main Street isn't an accident. It's the result of monetary policy technological disruption, concentrated in just a few companies, and an economy that's increasingly designed to benefit those who already have wealth and assets. The K-shaped economy is real, it's growing, and it's reshaping what the American dream looks like. So here's what I want to know. What surprised you most in this video? Are you on the upward or downward slope of the K? Drop your thoughts in the comments below. I read every single one. And if you found this valuable, subscribe and hit that notification bell so you don't miss the next breakdown. Things are changing fast out there, and you need to know what's really happening. Thanks for watching, and I'll see you in the next one.